And we're going to address that today. The euro crisis really raises some serious issues about Europe. We have definitely learned that it is not like the United States. It is not the United Countries of or United States of Europe. And we're going to explain why that problem puts the euro and Europe in a very precarious position and will end up causing currency problems for a long time. We had the birth of the euro back in January 1, 1999. We had a small number of countries that were members at that time. And as you know, it was a transition. It was not a quick movement into a euro because they wanted to set the stage to have a very stable currency, and they used a European currency unit to try to accomplish that over a couple-year period. In any event, what they were able to do was set up a European central bank to control monetary policy throughout the area. What they were not able to do was to set up a common federally oriented fiscal policy management system. So you have a centralized monetary control required to stabilize the euro among all the member countries, but also to oversee the management of monetary policy in the area. But fiscal policy is a different story. It is managed by each individual country, so you have a natural conflict, a policy conflict or paradox that has been created. That is the big difference from the United States, where we have a common central bank, monetary policy, and common fiscal policy. So the taxing authority, the spending authority becomes country-based, and that's what kind of developed the issue with respect to Greece. Here we have a slide showing the periodic breaches in the fiscal policy guidelines that have been set up by the European community. They have been repeated over the years. When countries get in trouble, you run into some pretty serious issues. Well, this has been going on. And then you've had, what are these budget deficits are domestically financed or internationally financed? If they're internal, the problem is a little bit less serious, but as soon as it becomes internal and then goes external, as in the case of Greece, then you have the linkage to other member countries in the European area, and that becomes a problem. So where do we come from? Well, this is kind of a slide of the volatility that we have seen with the different dates that relate to it, and you can see that historically, because of this juxtaposition between managing monetary and fiscal policy, and external factors that influence the euro area, we have had pretty significant degree of volatility. In September 2008, we began to move into a different issue. We had a global economic crisis that was precipitated by financial problems beginning in the United States, then being transferred to the UK, and then was transferred globally beyond that point. As a result, the EUROZONE went into deep declining growth. And since you had a common monetary policy, you could make that easier among all countries. But individual countries then looked to their own governments, elected officials who would like to stay elected, to solve the problem. And therefore you had governments issuing a lot more debt, borrowing, and stimulating, using fiscal policy to try to stimulate or insulate the individual member countries from the degree of downturn in the global economy. The euro area general government debt rose very rapidly, as we can see here. We were up to a huge amount of debt outstanding, and there's two types of debt here that can be held by foreign. One is the government debt, and that's fiscal stimulative policies to insulate you from recession. But then there's also the private sector debt, private companies that needed to get access to outside funds to try to, not go under with the downturn in economic activity. Greece became the first kind of tipping point. They borrowed dramatically. It's estimated that they currently have about 500 to 540 billion, both public and private debt, government and corporate debt, held by foreign countries. And that raises a debt service problem. They have huge year-to-year servicing requirements. In 2010, even before the problem began, they had run up a 60 billion plus debt servicing requirement. With the downturn in world trade, their shipping revenue was down, tourism revenue was down. Those account for between 50 and 60% of Greece's gross domestic product. Greece therefore became the first target. The fiscal spending that the government tried to initiate, they could not, they weren't getting the inflow, the currency to service the debt. That became a problem. What was the euro going to do? The Eurozone members, with the support of Germany, finally did come up with a $1 trillion rescue package to both guarantee the governments as well as the banks inside the Eurozone. The banks inside the Eurozone raise another issue, and that is that a lot of Greek debt, almost half of it, is owned by French banks. And the French government. So you now have an issue of, if Greece goes, that puts stress on France. Germany is the next big holder of Greek debt. So now you've got more stress on Germany, and this ripples through the other countries of Europe. Spain, Portugal, Ireland are in a similar situation that Greece are. And again, most of the European debt, particularly the corporate debt that has been issued externally, is held by banks in the European zone. So you have a lot of counterparty risk building, which tells me that as each one of these countries go through their particular restructuring problem, that's going to reflect on other countries in the Eurozone. Currency crises are going to continue well beyond the current period euro. We will remain under pressure. So you have huge debts here, budget deficit as a percent of GDP or debt as a percent of GDP. You're looking at what the government owes right now. And as I said, these are vulnerable countries. UK has a very high per capita foreign debt outstanding. You know, even though it's not a member of the euro, it still trades with euro primarily. So there's a lot of counterparty risk in this crisis that is not at first evident, and this is going to continue. So we have huge increase in debt. Euro countries are way beyond their 3% debt limit. Management right now inside the euro is out of control. This raises or caused some people, we've seen in the questions already that have come in this morning about will there be a euro going forward. It raises that kind of question. I think there will be. It may be at a 1-to-1 ratio to the dollar at some point and be very volatile along the way in getting back to it. This is kind of the vicious circle that Europe is caught in right now. Increased debt service, rising government debt, higher interest rates, slower economic growth, stimulus to more spending, rising. If the governments don't do expansionary fiscal policy, or if they do offsetting restrictive monetary policy, then economic activity in Europe is going to slow down. That impacts the US. It also impacts emerging markets. So this is not a European-specific problem. This is a very broad problem. Okay, I've kind of already covered this. You know, these are the various newspaper reports that are going on out there about the future of the euro. There is this structural problem in Europe that does need to be dealt with. That is not going to be easy. As we've seen, Germany has said, wait a minute, I don't want to pay for Greece when they're not working as hard as we are, when they don't, they're not as diligent as we are. And Merkel was able to get through that first stage, but her political future is tied up into this also. So this is a long-term problem for them to get out of. This is not a short-term problem for the euro. Well, in addition to what's going on in Europe, we've